If you are going to be a great investor, you have to fit the style to who you are. Buy and hold becomes mantra at the end of a bull market. Buy and hold becomes anathema at the end of a bear market. To get started, I'd suggest the following 4 books: The Intelligent Investor by Graham, Common Stocks and Uncommon Profits by Fisher, Why Stocks Go Up and Down by Pike, Buffettology by Buffett and Clark. If you read these books thoroughly and in that order and never touch another book, you'll have all you need to know. Another book you might want to consider is Value Investing Made Easy by Janet Lowe, a quick read. Charles Mackay wrote Extraordinary Popular Delusions and the Madness of the Crowds, a book I highly recommend, a must-read today. Everything I do in investment is just very different. My strategy is not very complex. I try to buy shares of unpopular companies when they look like roadkill and sell them when they've been polished up a bit. Management of my portfolio as a whole is just as important to me as stock picking, and if I can do both well, no, I'll be successful. It is a tenet of my investment style that, on the subject of common stock investment, maximizing the upside means first and foremost minimizing the downside. The deleterious effect of permanent capital loss on portfolio returns cannot be overstated. I just go for what has value. To me, ignoring tech does not make sense. In my opinion, applying traditional value criteria to tech is deadly, because there is usually a reason it looks like a value, and it is too technical to understand. So in tech I look for, first, big, Buffett-like established companies with tremendous cash-generating ability that are out of favor despite a franchise on something. Second, small techs trading at about cash with no debt. They usually do well in my experience. Effectively, you need to use technical analysis. In futures, I learned a lot about technical analysis. The frustrating thing was, it worked. You could actually predict the moves. My futures experience led me to study technical analysis intensely. I can't help but use it for position entry in stocks. Using technical analysis, you can find, say, when a company is bumping up against some significant overhead resistance, hitting a trend channel boundary, or hitting a Fibonacci number on a retracement during a downtrend. There are lots of other examples. Then, you just set a mental stop to get out if the scenario does not play out technically. I found it hard to leave technical analysis completely behind. Mainly, I use it only to avoid falling knives and to find buy points at very solid support. I try not to use it to sell stocks because my horizon remains long-term. With the market this toppy though, I find it hard to ignore when technical analysis says sell after a fast rise. It's the old take the money and run. It has helped me tremendously, and I have been hurt when I ignore it completely. Maybe technical analysis is only useful because others use it. I don't know. But It's interesting to watch, and I believe in it, to the degree it reflects crowd psychology. Stops are not a part of value investing as I understand it. A cyan portfolio will be a concentrated portfolio, though, and I have generally thought that in any market environment, I should be able to spot the handful of investments that will make all the difference. I like to hold 12 to 18 stocks diversified among various depressed industries and tend to be fully invested. This number seems to provide enough room for my best ideas while smoothing out volatility. Not that I feel volatility in any way is related to risk. Hard to figure what a stock will do in a 1-year period, especially illiquid ones, bought for fundamental reasons. I generally don't buy stocks unless I feel very comfortable coming out well in the end, by just holding if all else fails. In fact, I leave the dogma on the market direction to others. What I rather expect is that the out of favor and sometimes obscure common stock situations in which I choose to invest ought to do well. They will not generally drag the market, but I view this as a favorable characteristic. I also invest in rare birds, asset plays, and to a lesser extent arbitrage opportunities and the companies selling at less than 2/3 of net value, net working capital, less liabilities. I'll happily mix in the types of companies favored by Warren Buffett, those with sustainable competitive advantage, as demonstrated by long-standing and stable high returns on invested capital, if they become available at good prices. I have a simple philosophy: sell on new lows. There are 2 reasons for this. First, many people do this. It's a self-fulfilling prophecy. Second, if I know something is fundamental value and it breaks to new lows, the selling is irrational by definition, and I don't want to be in the way of irrational selling. Better to wait for the buyers to show where they are willing to step up and give support. I suffered for several years trying to be stubborn in the face of irrational selling, and all it got me was a lot of 50% haircuts on stocks that had already been too cheap. One of the biggest lessons I've learned was that PE8 stocks can become PE4 stocks and stay that way for a long time. Investors should own a concentrated portfolio of high-quality businesses that can deliver strong organic growth even if the economy falters. I do not view fundamental analysis as infallible. Rather, I see it as a way of putting the odds on my side. When I first happened upon the writings of Benjamin Graham, I felt as if I was born to play the role of value investor. All my stock picking is 100% based on the concept of a margin of safety, as introduced to the world in the book Security Analysis. My weapon of choice as a stock picker is research. It's critical for me to understand a company's value before laying down a dime. I usually focus on free cash flow and enterprise value, market capitalization less cash plus debt. Volatility does not determine risk. I will always choose the dollar bill carrying a widely fluctuating discount rather than the dollar bill selling for a quite stable premium. I don't believe anything unless I understand it inside out. There's a way to win at everything. It just has to be found. Graham makes it quite clear that value stocks will be punished every bit as much, and probably more, in a market downturn. Speculative stock bubbles ultimately see the gamblers take on too much debt. Margin debt popularity accelerates at peaks. I think a lot of funds get their ideas from Wall Street. I just like to find my own ideas. I read a lot of news. I just follow my nose. A lot of times it's a dead end, but sometimes there's value there. I am a firm believer that it is a dog-eat-dog world out there. And while I do not acknowledge market efficiency, I do not believe the market is perfectly inefficient either. Lost dollars are simply harder to replace than gained dollars are to lose. I have always believed that a single talented analyst working very hard can cover an amazing amount of investment landscape, and this belief remains unchallenged in my mind. Hard work has never guaranteed freedom from failure. If you are not failing, you are not working hard enough.